Is 2% inflation dead? Here's what it means if the Fed changes the rules.
Right. So if you guys may or may not know, for years there was hardly any inflation. And then when the dollar decoupled from gold in the 70s, we started to see inflation. And the Fed at some point said, okay, our inflation rate target is 2%. So it was never supposed to be anything, but now it's 2%. Now they're actually talking about maybe raising it, right?
Well, we're not hearing about it yet because right now they keep lowering or keeping rates high, right? But now with this new jobs report, there's going to be pressure to lower rates. And if you lower rates, what do? You up inflation. And I don't think we've even hit their 2% target, but we're close right now.
Yes.
So they're going to then need to move their target to 3%. So there's kind of like, what does that mean, right? If the Fed is moving its inflation target, which it hasn't done since the 70s, right?
I'm not exactly sure when, but they did talk about this like, a couple of years ago. They talked about maybe moving the inflation target. If you guys remember in 2022, inflation went up to 9.1, right? Like, remember? And then the Fed kind of reacted late and they started doing these rate cuts, as you guys know where that went. So we went from really, really, really low interest rates to really high interest rates, which brought inflation down. And, now it hasn't hit 2 yet, but that has been the target up to this point. So this moving in the needle could happen. I will tell you, just before we jump past this, I think this is a really important note. 2% to 3% is 33%. Like, just wrap your head around that. That is a big difference. Now, I don't know if it's 3% is going to be the number, but the point is they're essentially saying, if you save money, we're going to target a 3% inflation rate. So you savers are in big trouble. Anybody who has fixed income saving or anything like that, this is a big, big problem.
So I guess the 2% target inflation rate, this is interesting, I just looked it up, was implemented in 2012.
Okay.
Which is interesting because that was 4 years after, the Great Recession. And now we're 5 years after COVID, which was like basically our last quote unquote kind of recession. So now might be adopting this 3%. So it's not abnormal for them to be moving this needle, right? After a hard time.
You bring up a really interesting point. So just go back to 2012, guys. How much money did we print since then? Like, think about that, right? So what happened right before that is important. What happened before that, I went through this. Danille, she was a mere youngster. But I remember they bailed out the banks. Lot of printing, bailing out the banks. So back in 08, 9, 10, 11, let's say, there was a lot of printing, a lot of bailout to the banks. It was called TARP, T-A-R-P. This cycle, the pandemic, they bailed out the people. It's a very different scenario. So there's some say that the banks paid that back. That's a whole different topic. But the point is, this one went straight to the people. As you guys remember, the savings rates went way up. And it's just a form of UBI. I think George calls it stimmy checks, right? We all got money. Everybody was spending it, and like drunken sailors, right?
Yeah.
So that went up. Then crash. Just go look at U.S. savings rates. Then crash. And then what's happened since then? Credit card debt has gone over $1 trillion. Now it's, I think, 1.3, 1.4. So we obviously did not learn anything, but that money is in circulation. And so they do have, to your point, there's a lot that's happened in the last 12 to 13 years.
Yeah. And the real question is, okay, so what are the implications on real estate and everything else if inflation target is moved to 3%? Because that is what we believe will happen. Because if they are going to have to start lowering rates because of the job numbers, that is going to spike inflation, right? So we do believe that is what they're going to do, is change the inflation rate. But what would happen if they did that? So first, you have to look at hard assets. Hard assets move with inflation. So this is actually good for people that own hard assets.
Let's explain what that means. Okay. So we're a builder, right? So let's say a 2x4 or whatever the cost of a 2x4 in 2010 was, it's significantly more today, the same 2x4. So, let's say in 12 years, it's 30% more. Okay. That 2x4 now gets put into a new house. at 30% more. So that's what inflation does. It's the same 2x4, but it buys you less. Your money goes less far.
Mm-hmm.
So that's what inflation does. And you guys don't see it. So when we talk about hard assets, we're talking about those kinds of things. So you're actually hedging. If you're buying, let's say you buy a lumber yard at today's prices, and you have all this inventory, and then 10 years later, all that inventory in that lumber yard went up as a result of these kinds of inflationary things. So, and then that makes it, then you sell them to home builders or multifamily builders or whatever it is. And so when she's talking about hard assets, we're talking about actually, it's almost like a put with the stock. You're in the game now. You buy a house for 200 grand. And as it inflates with you doing nothing, let's say you go on vacation for 5 years, the Fed's basically saying it's going to inflate by 10%, 2% a year times 5. So that's what we're talking about when we say, a hard asset. If not, you're actually in savings. So the people that are in savings, like people like my mom who have a fixed income, they're the most in trouble. The seniors are most in trouble. And that's why this inflation adjusted Social Security stuff is so important. And that's why there's so many people looking at that, because let's say you get a $2,000 check a month. Whatever the government says it should be adjusted for inflation for is huge. And then they either cover your costs or they don't, right? So that's what we're talking about.
But I could see people listening, like, who really cares? Inflation really is like closer to like 15%. Some people even say higher if you look at shadow stats. But you have to. So while I agree with that, and that is true, this is the government numbers, right? So if the government numbers have been allowing for 2% and you think it's 15, imagine what shadow inflation is going to be if the government allows for 3%, basically, is what we're saying. Because this is what the government's allowing under their, we all know they calculate inflation kind of wonky and everything else. But now they're letting that extra 33%, slip into here, which is what it's going to do to real and actual inflation. And Ken has a good point, too, is this is, per year, right? So, hard assets, it's going to make them inflate faster than they've just normally inflated, not from 2020 to 2023, but what they've normally been doing, from 2010 to 2020, they always naturally inflated, and now they're just going to naturally inflate more. And that's if they can even hold this 3%, because now they are balancing a job market and inflation numbers.
Well, that's the thing. And then all you got to do is sprinkle the tariff discussion over the top. And as you guys know, the CEO, Tim Cook, was from Apple, was at the White House recently. And why would he go to the White House? I'll tell you why. They've already figured, if you're a company like Apple, you have 100% gone, oh no, like inflation, we inflation plus tariffs. We have all these things being made, let's say all over the world, mostly in China, for example. I can't remember, but there's a reason why your iPhone is $1,000. Is that about? I haven't bought one.
I don't know.
Let's just say 1,000, 1,500. And so they already know what these tariffs are going to do for them. And guess what they can't do? They can't charge the consumer $3,000 for this phone. So now they're in a pickle. They're like, okay, we have to take that. We have to figure out a way to reduce our costs. And so Apple now is going to be dealing with these margin issues, right? Their margins are going to go down. Maybe they can pass some of this on to the consumer, but this is precisely what Trump was talking about, where, an economist who's sitting there, in front of some camera, is just reading a script, is saying, oh yeah, this is going to pass directly on to the consumer. Well, I will tell you, nobody's going to buy a $3,000 iPhone. So Apple now, of course, is saying, okay, Trump, we're going to invest all this money, in $600 billion, by the way, into these AI campuses around Houston, but they're really there to talk about the inflation, right? Because this to them is inflation. That's what that means. These are rising costs to a company like Apple. So that's what's sprinkling into next year. And so back to the Fed. So why does that matter? It matters because real inflation could be significantly different next year, because all these big companies are already projecting what do these costs mean to them.
Yeah, and a lot of that is the tariff discussion, because they don't understand, what tariffs are going to do to their products, and a lot of them get a lot of things from overseas. So, I mean, and to your point, they can't pass the whole thing on to the consumer.
Right. But they have, if I'm Apple though, I've got a whole team working on this.
Yeah.
What does this mean to our costs in 2026, right? So they probably do have a pretty good idea, a range, let's say, right, of what that's going to be if they have to manufacture back in the US, right?
Yep, exactly. And I think too, what's interesting with the inflation numbers is, it's not really great for the lenders, right? Because fixed rate debt is an asset for the borrowers. And I always say this, and I this is like my conspiracy theory, but I don't know how much longer we're going to have 30-year fixed.
Oh, I know.
Like, I really don't.
Oh, yes, right.
We're one of the only countries that
countries. Like Canada resets like every 5 years or something. Mm-hmm. So what that means is you get a loan up there, just like ours, but in 5 years your loan matures, right? Here it's 30. So like Danille has she has a property with a lot of equity in it, but she has like a 2.5 or 2.8%.
2.8 or something.
2.8% loan. Okay. What this really means is the lender gave her the money to buy the property in the form of a mortgage. And guess what? It's tracking with inflation. So she's basically she's actually using a lender's money. She's actually tracking inflation. So she was able to go get it from somewhere else, from a bank in this case, at a rate that's about the inflation rate.
And what's interesting about that is that, if the bank is lending you that money and then that's just where it's at, like, they're going to lose money if you're set at that price for 30 years, and you can look up fixed rate loans in Canada and they actually pull up. It'll say they have 30-year fixed loans. You just have to look at the terms, because I got confused about this for a while, because I would hear on here that we're one of the only countries that have it, and I would look it up and it didn't appear that way. But when you look at the terms, it is a 30-year loan and it is fixed for 5-year increments. So they call it a 30-year fixed loan, but it's not like we have it where you get it on day one and on year 30, it's the same interest rate. It resets. Right. So it's going to be interesting if we end up keeping that. Now, of course, in the short term, we will, but over the long term, because the banks just can't sign you up for things they're going to lose a ton of money on, right? And if we have this bigger inflation, they're going to be calculating that into, their rates and, what they want to lend at.
So, right. So here's how it works. And this is the actual statement that you need to remember. Higher inflation erodes the real value of debt. Higher inflation erodes the real value of debt. So what does that mean? What that means is, in Danille's case, where she's got a 2.8% loan, that's somebody else's loan, by the way. Don't forget, she borrowed from a bank. Was it a bank?
Mm-hmm.
Yeah. Okay. It's sitting on their balance sheet, right? So she owes them, and it's an asset for them and a liability for her. That's how that works. 2.8 from somebody else. Now, it doesn't matter if it's a bank or it's an individual or it's a pension or a credit union or life company. It doesn't matter. The point is, it's somebody else's. It's OPM, other people's money. Okay. Now, when inflation could potentially roll, let's say it goes to 3, 4, 5, 6%, she's crushing it because she now has other people's money that's way below the cost of inflation, right? Mm-hmm. So she's basically using other people's money in a hard asset to hedge inflation. And the asset itself is growing much quicker at a higher inflation, eroding the real value of the debt. So now you got to wrap your head around this one. What it really means. Let's say that debt is $200,000. Imagine what $200,000 is going to be in 20 years, right? So if she keeps this property for passive income and the tenant pays it off, $200,000 is going to be nothing. Like, imagine what what it was 20 years ago. So we know that inflation rate over the last 20 years has been, it's 30-40%, something like that, right? So it's probable to think that's going to continue. Now, if they increase this Fed rate to 3%, and that's their target, you could already tell that Fed's target is 30% over 10 years. That would be 60% over 20 years. 60%. So this is kind of the point. So if you know that the Fed is going to be targeting 3, right now it's 2, and you're in cash, potentially your dollars in your bank or whatever it is you have in your wallet is going to buy less based on their own admission of what inflation is going to be. And so this is kind of the point. This is why you need to be in hard assets, because as you guys know, it's always, if you price your money in gold, or you price your money in Bitcoin, or you price your money in watches, or you price your money in other things other than cash or real estate, it has a very different scenario, right? Right?
Yeah, absolutely. And what'll be interesting too is because this is, harder for banks, if they'll keep their rates higher for longer, right? Like maybe it doesn't make sense for them to drop rates down to, 5% if, for lending, if this is a long-term loan and, inflation is at 3.
Right.
It might keep them higher based on it if they do that.
And I'll give you guys a couple actually silly examples. So when I first started crushing it in real estate, what I consider to be crushing it, I went out and bought a Rolex. And I bought that, it's been 30 years ago, let's say, right? And I don't sell watches. I don't buy and sell watches. I just buy watches. So I have a ton of watches, as Danille knows now. But anyway, at the time, it was like, holy moly, this thing's expensive, right? I've sat in my safe forever because I upgraded and bought others. Well, finally, I pulled it out. I was going to give it to my son for Christmas, which I did do. And I couldn't believe how much it was worth. And guess what? Why? That's the question. Why was it worth twice as much as what I paid? Had nothing to do with my savvy investing of just buying something like that. And so now it can go the opposite too. If you buy a flat screen TV, it absolutely positively could be deflationary or, devalued. And there are things that definitely are worth less, electronics and stuff like that. But this, so that's kind of the point. What seems expensive today, if it's a hard asset, something that a lot of people are going to want at some future point, you could very well see, you just got to get out of cash and you got to get into things that are going to rise with inflation. And that's the key. It doesn't have to be real estate, guys. It does not have to be real estate. I've done it with Ferraris as well. I thought I was spending way too much on one. And then next thing you know, my trade was as much as I paid, like 6, 7, 8 years later. And so, so the same thing, but the next one and the next one and the next one. So things appreciate, things inflation, or things inflate. And so that is the point. It doesn't all have to be real estate, but debt in particular, Danille's point around debt is very, very, very important, because you plant yourself, put a flag in the sand, and you're like, my debt is 200. In her case, it's going to be 205 years. It's going to be, be paid down a little bit by your tenant, I suppose. But the point is that inflation is going to erode that debt. And that is the point.
So let's chat about stocks. So how do stocks do? Because, you have to think if stocks really are tied to business performance, and if we have higher inflation and it's harder on businesses, and stocks really aren't hard assets. So how do stocks normally perform?
Well, I don't know about you guys, but I don't know. Stocks just confuse the hell out of me. Like it doesn't even seem like they track the like with Ross and I, we run our business and we know what we make each month and each quarter. But with the stock, it doesn't seem like it kind of does that.
Yeah.
It's like people pile it on and that's what makes stock go up. In fact, I was just looking at, was it OpenAI? OpenAI, yeah. OpenAI is crushing it up as a stock. But one of the things the analysts told me this year, remember? It doesn't actually break even until 2029.
Well, they don't really know it's going to break even in 2029. That's such a projection for years.
So how does the stock go like that? And the company already knows it's probably not even going to make money for 4 more years.
Right.
That to me is, it's just people piling on. It's irrational exuberance.
So let's chat about, when Trump, gets to pick his commissioner and a lot of the board, I guess, in May of 2026. So that's when we're kind of sensing that this will all kind of start to come together because, Trump's dramatic. I was telling a girl yesterday on the phone, I go, normally you don't always know what a president's going to do, but Trump is dramatic. And we do know he gets to pick his commissioner in May, and he's not going to just want a quarter point cut. Like Trump is going to want something that makes a headline, probably a point, maybe, point and a half. You never know with him, right? So he's not going to want something that's old news, right?
Yeah.
So he's definitely cutting rates. I think Powell will start to cut rates later this year, but Trump is definitely going to cut them to where he wants them if they're not already there in May. And it'll be interesting because that's when it's going to reignite inflation. But Trump doesn't really care about inflation. Like he's not really one to balance inflation with, the economy, right? He just wants a economy that's moving and prospering, and inflation is just part of that.
But let's talk about why. So here's my view. By the way, I do want to get into this because I think it's a fascinating discussion. The U.S. is in massive debt. So let's go into Danille's example of the 200 grand, right? The U.S., I don't even have to know how many trillion. You guys all know we're printing like crazy. So the U.S. is in debt. So also, what does inflation do to U.S. debt? Just cross the word U.S., put Danille's name in it, put my name in it, put your name in it. It's debt. So once again, high inflation erodes debt. It happened after Vietnam, when we funded the war. I'm telling you guys, high inflation back in the 80s, because I was a kid, I didn't understand it then. When interest rates were 12, 14, 15, 16%. I remember that actually. And I didn't quite get it. I didn't understand. But the reality is that we were in this hangover. The U.S. was in a hangover of spending all this money on the war. And so the inflation does erode the U.S. debt. So think about that. If you're thinking about why would Trump want high inflation, it would be 100% to try to kill the debt, because you'd be paying it off today with cheaper dollars, right? Mm-hmm. So that is kind of the point. So I agree with Danille. He's going to pack the Fed board, right?
Yep.
He's going to pack that Federal Reserve board with doves that support his rate cuts, right? Despite whatever the Fed decides, right? Yep. Powell's going to be there till May. Make no mistake about it. That Trump is going to say whatever, but he's going to keep touting his horn.
Well, and Trump might be the one that pushes for the 3% inflation rate, right? Because possible. I mean, not maybe him himself, but maybe the board member that he elects, right? Because I don't see Powell doing this, but there's a lot going on between now and May, right? Because normally you don't really know. I mean, when's the last time you even cared, most of you, who the president elected as the Fed chair, right? Like,
Yeah.
So
when's the last time we had that discussion?
Yeah, exactly. Like, when's the last time we had that discussion? So it's like, it's a big deal now. But we also know what he's going to do. Like, we know he's going to elect someone that wants to cut rates. We know that this is coming. So knowing that this is coming when you're a real estate investor or an investor in anything, you have to know that inflation is going to go up when all of this happens. And to Ken's point with real estate, if real estate's more expensive to build, it naturally over time is going to be more expensive to buy, because you can't have cheaper home, you can't have new builds that are exorbitantly more than older homes without older homes, raising in value.
I always tell people, go back. Somebody said this to me one time. It said, what was the cost of your childhood home?
Mm-hmm.
Like my mom, as I talk about my mom all the time, right? My mom still owns the home I grew up in. Now it's rented right now, but that's not the point. She paid $10,800 for that home in the 60s. Okay. Mm-hmm. That thing's worth over $700. Maybe it went up to $750, closer to $8. Maybe it's back down to $7. That's irrelevant. Just go back. We're talking about 60 years, right?
Yeah. My childhood home was 70 grand.
Yeah. Okay.
Yeah.
Now, why is that? Is that because my mom, who was a hairdresser her whole life, was such an incredible real estate investor? No.
Right.
She paid it off. I remember when they paid it off, they were proud of that. That was back when the dollar was tied to something. It was tied to it was a part of the gold standard. But regardless, when Nixon took that off, inflation went up and the house went up. Just look, I mean, just honestly, we just had a great event called Limitless in Dallas, and I had this conversation with Larry Lepard, who wrote the book The Big Print, by the way. Fascinating book. He basically said, if you go back and track money printing from the 70s, right, in all forms, all things, all this, all that, it actually does track inflation pretty good.
Yep.
Pretty close. So now, not exact. I'm sure there's rounding errors all over the place from year to year and city to city and county to county, state to state, based on everything that's going on. But the reality is, if you look at really big picture, it's actually tracks. So according to his book, and he's got all the data and statistics in there. If you want to challenge him, please do. But the reality is my mom, again, she cut hair her whole life, right? And my dad was in construction. So yet today, that's my mom's net worth.
Well, I was just looking. So the home that my parents bought, 40 years ago, for, 70 grand is now like worth like 400 and some $1,000.
Yeah.
And it's not, and it's in Ohio, and it's not a real prosperous up and coming area. It's just, to your point, It's just inflation.
That's
right?
it, guys. That is the point here. That's the point we're trying to make to you. Like, these are not real estate investors. Your parents, my parents, they're not real estate investors, but they own real estate.
Mm-hmm.
And so they give money to financial planners and wealth managers and all that stuff, and they say, please, 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 make me money on my money, and yet, what's actually underpinning everybody's wealth these days? It's the equity in their home. Like my mom. My mom had some savings, but it was worth a lot less. And I'll just real quick tell you another story. Danille knows the story. When my dad passed away, we had to dig into his estate for what it was. And one of the things was an insurance policy that he bought also around the same time for 10 grand. So my dad bought a house for a little over 10 grand and an insurance policy for 10 grand. Guess how much the insurance policy was worth? 10 grand. So when my dad passed away, my mom got 10 grand from an insurance policy that he held for over 50 years. And the same thing, and this is kind of the point, the insurance policy was not inflation adjusted. So it was fixed. It was fixed at 10 grand at the time, which was a lot of money when my dad bought it. In fact, I was talking to Peter Schiff about this, and he goes, and another way to say that is, your dad bought an insurance policy that was also the price of a house. And I said, yes, at the time. That's how it looked to him. One deflated based on inflation, and one rose with inflation. And that's really the point, and that's what we want you guys to understand. Where we're headed in the next 10 years, you can jump on this train. You can be the life insurance policy, or you can be the real estate or hard asset. Either way, inflation's coming, and it's just which road do you want to take?
Yeah, and that's why boomers are doing so well, right? Like, we hear that boomers are doing just so good compared to Gen Z, and they have all this money. But the truth is that it's because they invested in real estate. Like, most boomers bought real estate when they were younger. Granted, it was more affordable, but, they didn't buy it for anything close. It's worth so much more now than what they bought it for, that they're kind of fine. Like, they can do home equity lines. They can sell their place for cash, buy a smaller place, have money for retirement. I mean, my parents are in that situation. But what people don't understand that are in Gen Z right now is, if you get into a house now, like, people somehow think this is like the cusp, right? Like, homes are like 500 grand. And like, when we retire, they're going to still be like 500 grand or maybe 600 grand. No, like, you're going to have the same. It's harder to get into a home, but if you can get into a home, you're going to have the same situation in 30 years when you retire, 40 years when you retire. Your house is going to be worth way, way more as well, just because of inflation, not because, you really did anything. You could just buy it and sit on it. It's not going to be worth less. Like, it was really interesting. Ken and I broke down on one of our lives, like, home prices, from 1920 to 1930 to 1940, all the way to 2025. And every 10 years, they increased in price significantly, even from 2010 to 2020, which you could argue was a very rough time for real estate, the great financial crisis. Prices had still increased to 2020. So your house is not going to decrease in value. That's why you have to think when you want to buy right now and you're worried, like, what if prices go down next year and I could have got a better deal if I waited, or maybe they go up and I missed the boat. Like, no matter what, if you hold this property for 10 years, it's just about guaranteed that it's going to go up in value. And certainly if you hold it till you retire. So, you shouldn't have all this thinking, because at the end of the day, you might kick yourself that you were hoping to get a $20,000 discount on a home, and 10 years from now is going to be way more expensive, and you're going to wish you bought it for that price, And that's what people need to wrap their head. We're not at this cusp. Like, home prices just go up, and it's not because gold or housing or crypto is just such a good investment. It's just because of the inflation of our dollar.
So you just got to ask yourself, in 10 years, are you going to be better off financially if you rent or buy? That's it. Right? Period. Right? I get it. One's a little bit more of a financial sacrifice for sure. Only though, if you take those excess dollars and put them into hard assets, right? Because if they're sitting in cash, or you're spending them on, trinkets, or, all the little things that we all do, when we have excess cash, where the savings rate is just flat, even savings itself is going to get eroded to inflation. So I think that this target is important to watch. Now, of course, they've talked about it in the past, but it would not surprise me if it goes up. And I think, in our live this week, the real wild card is unemployment, which is the other mandate of the Fed.
Yep.
Unemployment's big, guys. And
it's going to only get worse with AI.
Yeah. AI, as you know, is already, my friend who's a lawyer said paralegal jobs are done. It's coming after the marketing industry. We have friends that have lost their jobs already in the marketing industry for graphics and content writing. I have a friend that has a PR company, and he went from 160 to 110 people already. There's all these things happening. And so employers are saying, as people turn over, can we be more efficient with AI, and so that's happening. And so that is going to happen. I'll tell you what, I think Powell's going to get out of there just in the nick of time, to be honest, because we have tariffs that are supposed to show up next year, and we have unemployment, which absolutely positively has to show up next year, in my opinion, right?
Yep.
So you've got these two things that the Fed's supposed to be in charge of, that it's going to be stressed, very differently.
Yeah.
Right? So you got AI on one side dragging on the employment side, and then you got the tariffs on the other side, and all the other stuff on the other, right? With all these trade things that are happening right now. So that Fed chair, that's not a job I would want.
No, and I it's going to be interesting, right? Because depending on how bad this recession gets, and everything else will determine, how much the real estate market goes down, right? But there might be this sweet spot towards like the end of this year, beginning of next year, before Trump lowers rates significantly, where it might be a really good time to buy. And I'm really watching that myself. It's like, if he's going to lower rates, then there might just be this sweet spot, right? And the only thing that could caveat that is, how bad is the economy going to get, where maybe lowering rates won't help, right? And it'll continue to go down. So I'm really watching the economy closely. I'm really going to start looking to buy here in the next, fall or early spring of next year. Because I do think once Trump lowers rates, and I really believe he will, irregardless of everything else, I just think he would just do it. And I know everyone's going to say it's not his decision. It's the Fed chair, and they have a board. I know. I think Trump already knows that and is going to plan that accordingly to what he wants.
He doesn't care about that, but
well, no, but right? He'll just do it as a mandate.
No, he's going to push through. To your point,
he's going to push it, and he's going to put somebody in that's going to push it, and he's going to have that chair, put board members on that are going to push it. And I do think that, irregardless of everything else, home prices will probably go up when rates go down. Because I work with clients, right? It's like the rates just went down a little bit. So we've already increased the amount that they're looking at, because they have this set payment. Most people have this set payment. I only want to spend $2,500 a month. And so as a realtor, when you're working with that, you're like, okay, your budget was $350, but now it moved to $375 because rates went down a little bit, right? And then so more homes start to sell for that price point. So you just got to look at that. And I think that you don't want to miss that window. I think it's an important window.
You bring up a really good point, and it's a good one to kind of, finalize here. And that is wage growth, right? People like I was on a phone call this morning with somebody who lost their job and their wife lost their job. And they're both, I said, so how's that going? He's like, the job market's horrible, right?
Mm-hmm.
And he's in tech, and obviously the story. This is somebody I know very extremely well, and I'm like, okay, so what does that all look like? And and people are a little scared about this, right?
Mm-hmm.
And so I think that I think this unemployment and high inflation is going to hit. And to Danille's point, what Trump's going to do, he did this in his last, when he was president before in the 4-year period. He was pumping on there. He's a real estate guy, guys. So he believes that rates should be low. So Danille's exactly right. So I had a conversation with a friend. He said, "What do you think? I'm thinking about buying a house." And I said, I would wait a little bit because right now we got a bit of a frozen market. The buyers are frozen because the rates are still kind of high. And the inventory is starting to stack up, even though it's still low, in my opinion. So, but kind of to Danille's point, why don't you wait and see? Maybe you'll have some softening in prices because the sellers are making deals right now. And if you can get a lower rate, and it makes sense for you, I would strike and I would do it because you're going to see a run on inflation. And with Trump, you could always refinance on the way down.
Mm-hmm.
If he's successful. Remember, hedge up, refinance down. That's a great position to be in, whoever you are, right?
Yep.
You can lock your rate today and know you have the ability, even if it's at 6 or 5.5, if and rates go down to, let's say he's successful in getting them 3% lower, which is what he wants. Let's just say, just do it. Just go. Now they're at 4. I'm going to refinance. Now they're at 3. Now I'm going to refinance. Make it fixed. Call it a day. Your payment goes down. You're still in the money. Maybe it's a cash out refi. Maybe not. That's tax free because it's debt. When you would do a cash out refi, that's money that you get tax free because it's in the form of debt. And just play that game. But you got to be in the game. You have to have a hard asset.
Yeah, absolutely. And for those that came to Limitless, thank you. We had so much fun. It was a great event. We all learned a lot and made some great connections.
Yeah, 2,000 people, over 50 speakers, 6 stages. The Limitless Exchange was a huge hit. Mm-hmm. And in fact, I got 4 tickets to Berkshire Hathaway, so I'm excited about that. But thank you guys. Always great to see you. Let's keep learning.
And next year it's in Scottsdale, right?
Yeah, next year it's in Scottsdale, mid-August. LimitlessExpo.com. Anyway, guys, got a year. I got a year to. I got 6 months, so I gotta recoup. But so if you enjoyed this discussion and you want to hear a real take on where the real estate market's going in 2025, our live presentation from Limitless, and we go into lots of detail on the trends, and you definitely going to want to hear this.